Hey, it's Joshua Kittle here with another edition of Mortgage Clarity. In this video, we're going to talk about mortgage insurance. What is it? Should we avoid it? And just kind of really dive into this. So I actually had lots of clients that come to me, and when we first start the conversation about loans, at some point, some of them will mention mortgage insurance about how they absolutely do not want mortgage insurance. There's this idea that somehow it's just a complete waste of money and that they should avoid it at all costs. So this video is going to kind of help you because in most cases, this is not really true. There's actually a lot of benefit to mortgage insurance. And that's not to say you should always go out and seek to have it, but you got to understand what it is, why it's there, and how it can benefit you if it's necessary. So essentially what mortgage insurance is, it's an insurance policy that you, the consumer, are required to pay that benefits the lender should you default. And you're required to pay that because of either the loan program that you're using, like a government program, or because you're doing a conventional loan in which the first lien position, so that's your mortgage, the first mortgage, as a percentage of the value of the home is in excess of 80%. So when that happens, Fannie Mae says, yeah, we'll lend 95% of this property. However, we're going to require mortgage insurance in order for us to go ahead and make this a loan that could be sold to Fannie and Freddie. So there's some big difference here between conventional and government. So let's start with government really quick and how their mortgage insurance works. So with government programs, it doesn't really matter how much you're putting down. You're always going to have mortgage insurance. So with FHA and USDA, it's going to fall into two categories. And then with VA, it's one. So in all three of them, they charge what's called an upfront funding fee. It's still mortgage insurance, but it's a one-time fee that they charge you. They'll allow you to add it to your loan amount, but you're going to eventually pay that back. And that's for the privilege of using the program. And essentially that money does go in to fund that program. So with FHA, they charge you a 1.75% fee. With VA, they charge you, well, actually not VA, you'll start with USDA. USDA charge you a 1% fee, but they charge you 1% on top of the 1%. So it's 1.01%. They add it to the loan. And then with VA, it's a little bit more complex depending on whether or not this is your first time use or a subsequent use. Are you putting no money down or 5% down or 10% down? Are you regular military? Are you reservist military? Or do you have VA disability? All of this will go into impacting how that gets charged. Now, on the other two programs, FHA and USDA, in addition to the upfront mortgage insurance, they have what's called an annual premium. So with FHA, that's 0.85%. So just think about it this way. It's life of loan. So if your rates say 3% and they have that annual premium of 0.85, your rate's really 3.85%. But they break it into two separate portions there, and that one portion is basically going again to FHA directly to fund that program for those borrowers who default. FHA's got the funds available to make the lender whole. So now let's jump over now to conventional and talk about that one, because conventional is quite a bit different on how it works. So as I mentioned, on a conventional loan, you're going to require to have mortgage insurance if that first loan's more than 80% of the value. Now, there's ways to try to get around that. Before the market crash of 2006, it was very common for a lender to get a conventional first mortgage at 80% and then get some type of second mortgage for 20%. We call that an 80-20. So essentially they got 100% financing, but they didn't have to have mortgage insurance because that first loan was only 80%. Now the 80-20s, I haven't seen those around since then, but it is still possible to do what we call the 80-10-10. So 10% down, get a 10% second mortgage that goes behind the first mortgage, and then that 80% first. Now, where people get confused, they think, okay, great, I should do that and avoid the mortgage insurance. However, you have to realize that second mortgage, that's at a higher interest rate, and it might be at a shorter term. So its impact to your monthly payment can be different. Plus, how much higher is that interest rate, and how does that higher rate on that amount compare for just a 95% single mortgage with the mortgage insurance? And in conventional, again, it can be a little bit more complex because unlike the government programs where the MI or the mortgage insurance is fixed by the program, conventional, it's going to look at all kinds of things that's going to impact this cost. Are you putting 3% down or 5 or 10 or 15? As you put more down, the coverage amount reduces, and so you get a benefit on that cost. What's your credit score? On the government programs, credit score doesn't get impacted onto that MI, but it does with conventional. So higher credit scores are going to have substantially less cost for mortgage insurance than somebody else in the same scenario, but a lower score. And then it also looks at things like, are there multiple borrowers on the loan? More borrowers, less chance of default, lower cost of mortgage insurance. What's the debt to income ratio? For borrowers with lower debt to income ratios, they're not stretching their finances, so it gets that priced in. So conventional does all kinds of things to price it, which is really good, because what that does is it allows a lot of borrowers to get very affordable mortgage insurance. And you might be surprised at how affordable mortgage insurance can be. So these are all things you want to look into. Now, the reason I believe mortgage insurance is good is, one, if you had to wait until you had 20% down, most borrowers would probably never be able to own a home. They'd always be chasing that, because every month they're saving, but then every month the home value is going up, so they have to save more. And for most of us, it's going to be very, very difficult to save 20% down or even 10% down. So mortgage insurance allows the average person to be able to get into that first-time home. And there's huge benefits to homeownership, so that's a huge plus. Secondly is, perhaps a borrower has the ability to put more money down to either reduce the cost of mortgage insurance or get rid of it altogether, but that could cause a financial hardship. If a borrower scrapes all their money together that they've got to be able to get in and get away from that mortgage insurance, what happens is, as soon as you move into the house, something happens with work. You know, this current environment with COVID, perfect example, people bought homes, thought things were going to be great, and all of a sudden life just changed. And so I think mortgage insurance is really, really good, because I would actually prefer to see a client have less of a down payment and have mortgage insurance and have reserves in case something happens, than to put it all into one basket and just hope nothing goes bad in those first few critical years. The first few years are very critical. So there's that benefit. But then there's also the benefit of taxes. So if you're having to liquidate funds that might have tax consequences for doing so, what's that going to cost you? And you got to compare that against that mortgage insurance cost to find out whether or not that is a negative. So that's basically where I stand. So mortgage insurance, I do not think it's negative. I think for most people, it's great, because without that mortgage insurance, you wouldn't be able to own a home. And I think for some borrowers, even though that's possible to get away from mortgage insurance, before you make that decision to do so, make sure you're taking a holistic approach at the whole finances. Your lender should definitely be helping you with this. So if your lender is not talking to you about mortgage insurance and all the various ways to structure it and things like that, find a lender who will, because it is a cost. It's a cost you want to take into account, but it's not necessarily a negative cost if you structure it correctly. So I hope you found this helpful. If you did, please like it, thumbs up it, share it. It's really important just to help spread the word so people know kind of what's out there for options in lending. And if you got comments, comment down below. And until next time, have a great day.